Jim, would you take this over and teach us something about our energy pipeline and grid?
Sure. So Dave, thanks. Folks, I'm going to give you just a little more background on the firm to let you know kind of who we are and where we came from. We've been around about 20 years as a firm. My career spans 40 years. I started my career at the old Standard Oil Company of Ohio, majority owned by BP in 1982. Came to Wall Street in 1990, started a hedge fund in 1998 for 5 years, and on inbound requests, started EIP to manage money for other folks the way we were managing our own money, which was sort of more investing oriented, more tax efficient than what we were doing in the hedge fund. And so we manage about $5 billion today, do it with about 20 employees. 17 of which have a direct profit interest or ownership. So it's very much like a kind of like a family office. We have been in the industry a lot, not just on Wall Street, but actually working for some of the companies in the industry. You can see, I'll get my pen going here. You can see the companies that we've worked for in the industry. BP, Southern Company, Public Service in New Mexico, Questar, which is the Utah gas utility, and Enron. We've been around on Wall Street. And our expertise in this area has got us involved with regulators, policymakers, and NGOs, non-government organizations, and environmental groups. We participate in the Aspen Institute twice a year at their Energy Roundtable. We've submitted expert testimony to the Federal Energy Regulatory Commission and the U.S. Senate Energy Committee. I testified in front of that committee about 3 years ago. We still have an ongoing dialogue with the senior Republican as well as the senior Democrat on that committee. As you know, Joe Manchin runs that committee now, we're in contact with his senior staffer as well as the senior staffer of the Republicans. So it's a good dialogue to have. We represent to them sort of the how investors think, because we actually are investors, not traders, not a hedge fund, and that's valuable to them as well as us. We show these graphs a lot. There are 3 lines on this graph. The red line is the earnings, the blue line is the price, and the green line is the dividends of our total portfolio. Now, this is our separately managed account, which is very similar to EMLP in terms of its construct, but for regulatory reasons, we show something that's not a mutual fund. So what this graph shows is sort of how stable the earnings are, and what we're showing you is the history of the current portfolio. And as I'll talk about today, the more cyclical supply facing stuff out there has a slightly bigger weighting than it used to. So when we look at the history of those companies, even though they weren't in the portfolio 10 years ago, we're picking up their historical cyclicality. But this red line is less cyclical dramatically than the S&P 500. And a critical point about this graph is it shows you why you invest in equities, which is equities give you a total return because they throw off a dividend yield and they appreciate over time so long as the per share earnings and dividends go up over time. So if you were to look at this graph for a single stock like IBM, for example, whose earnings are lower today than they were 10 years ago, you would see a stock price that's lower today than 10 years ago. So as Peter Lynch said, the famous portfolio manager Fidelity, if the earnings don't go up, the stock price doesn't go up. Now they don't go up, in lockstep. So you can see in our portfolio sort of how well the earnings have done. This is a high single-digit growth rate, faster than the S&P 500. In fact, faster than any sector in the S&P 500, except technology, of course, with a much higher yield and a much less demanding valuation. But in spite of the relatively steady climb, the sentiment about what we did sort of went negative for this 6 or 7 year period. So this is sort of the MLP bubble that that Dave referred to, which, the stocks really got ahead of themselves and sort of came back down to earth. And that sentiment was driven a lot by oil and gas prices, even though the pipelines that we own had virtually no exposure to commodity prices. But there were other MLPs that did. People buy and sell indexes as a group. And if there's stuff in that index, which there is in the MLP index, that is highly cyclical in nature, they're selling our non-cyclical stuff with it. And they push them up in price and they push them back down in price. Then, of course, what happened was people started thinking that oil was sort of a buggy whip business, and utilities were to some degree the same as conventional oil. We're going to be victims of wind and solar, as opposed to the utilities being beneficiaries of new energy technologies. And the fact, and I'll talk about this more today, how conventional energy is a lot less of a victim than anybody thinks. And there's a sort of a very, very strong cycle going on, improving the sentiment about that area. So this horizontal trend for 6 or 7 years has finally sort of reverted back to normal, which is the stocks are rising with the earnings. And it doesn't mean that, in the future, you can't have another period of time where they go sideways. It also doesn't mean that, the damn stocks do something stupid and go up more than the earnings, because, that's what markets do. I don't believe markets are irrational. I just think markets are made up of a bunch of players who are uninformed. They just don't know the facts. And I know this because I talk to all these people. And if you don't know the facts, you just make poor judgments. It doesn't mean you're irrational. It just means you're making bad judgments because you don't have the information you should have. And I think that's a big difference, because if you believe markets are irrational, you believe they're random. And if you believe they're random, then there's nothing you can do to add value as a portfolio manager. If, however, you see the world the way we do, and our track record sort of bears this out, if you can understand people's misunderstanding by talking to them, knowing the facts, comparing your knowledge of the industry, what other people think, then you can make money off of their misunderstanding. But to call them irrational is an insult to irrational people everywhere. The value that we add in energy, and we kind of picked energy because this is where all of us came from. This is the neighborhood we grew up in. And so that's our expertise. But to make money in an industry that has a checkered past in terms of earnings cyclicality and growth, you can see the value we've added. So this red line on this graph is the exact same red line as on this graph. But instead of comparing the earnings to the price and dividend of our portfolio, we're going to compare the earnings of our portfolio to the 4 subsectors of energy. So this is the S&P Global Clean Energy Index, which is earning less than half today as it did 15 years ago, the beginning of this graph. All our graphs like this go back to 2003 when we started, but this one can only go back to 2007 because that's when that index history begins. The S&P Energy Index, which is Exxon, Chevron, Schlumberger, Halliburton, is this line here. Cyclical, not a lot of growth until the current cycle started. The Alerian Index is this dotted line here, which you'll notice has the exact same cycles as the energy index. That's because half the MLP index is cyclical commodity businesses. So it was always a lie to say that MLPs are energy infrastructure. MLPs are a tax structure. And those two are not the same. It's how companies are financing themselves and tell you anything about what it is they're doing for a business. And the utility index, more stable, but not a lot of growth. And so what we do in picking stocks is we look for stability of earnings, and that's really a function of how the business model is designed. And so the vast majority of what we own are legal and natural monopolies, where they either have a regulated allowed rate of return, like a utility. The poles and wires are always regulated monopolies. And in return for being granted a monopoly, the companies are limited in terms of what they're allowed to earn on their invested capital. They also have an obligation to serve. They can't say no shirt, no shoes, no service. If you want to build a house or a building and hook up to the grid, they can't say no to you. So they have this obligation to serve. They have limits on what they can make. And in return, what society gets is avoidance of duplication of capital. And so this is how utilities are run around the world, and it's over 100 years old. And the reason it came about was because of the disaster with the railroads in the 1800s. And in fact, it was actually Charles Francis Adams, who was the first sort of head of a railroad commission in Massachusetts. Yes, he is the great grandson of John Adams and the grandson of John Quincy Adams. And so, he was born with a silver spoon in his mouth, and he decided that railroads was what he was going to do with his, career, for lack of a better word. And he made the observation that the rail routes with the lowest prices and the lowest cost had the least amount of competition. And really what he was observing was a natural monopoly. So if you're running 4 lines between Pittsburgh and Cleveland when you only need 1 or 2, all of that capital had to be paid for ultimately by the public. And so having a regulated monopoly avoids that waste for society, but you've got to keep an eye on these folks that they don't run up their costs. So they have to be sort of, they have to be policed by the regulator because they have a monopoly. But just because they're limited in the returns they get doesn't mean they're not good investments. And at the end of the day, while there are some bad regulatory jurisdictions, usually it's the management that's the problem. And when bad managements are constantly complaining, or I should say, when managements are constantly complaining about the regulator, it's usually the management team that's the problem. And so we spend a lot of time getting to know the management teams of these companies, because at the end of the day, they determine what assets they own and don't own, and they determine their relationship with the regulators, and they determine whether or not they're a success. And I've always said that being the head of a regulated utility is the second hardest job in America. The first being a football coach at a major university like Michigan, University of Texas, or Alabama, because you got to win games without having kids that get into trouble. So that, I think, is definitely the hardest job in the United States, much harder than president. And so what these guys do is difficult. I mean, you have to run this electricity through the system. People can't get killed. It is a very dangerous commodity, and you have to keep costs down. And it's got to be safe. It's got to be clean. It's got to be efficient. It has to be reliable. It is a very difficult job, and the better people just do better. And because we know these businesses, we've been able to identify these people and their assets, and that's how we've been able to get this track record of earnings growth, which ultimately has driven the performance of the stocks. So, but enough about that. But to compare the yield and the growth and the PE, the 3 drivers of total return. Because remember, when you own a stock, you get the yield and you get capital appreciation. And capital appreciation is really just a function of earnings growth plus or minus valuation. So if you think about total return on this first graph, at the end of the day, this period of time, you had greater performance than growth because the PE went up, right? The price went up more than the earnings did. So the PE is higher here than back here. So total return is the dividend you're collecting all the time, plus the growth of the earnings, plus or minus this volatility. That's your total return. And so if you focus on those 3 things, that's going to drive your success as an investor. So when you look at the yield of our portfolio, it stacks up well with every sector in the S&P 500. We're second in growth only to the tech sector, which of course is starting to change. And PE, only thing we're more expensive than is the cyclical energy business, which we'll talk about in a bit, and financials. And of course, financials are cheap. They're levered 12 to 1, so they're highly risky. So the stuff we own is cheap, it grows, it's stable, and it throws off a yield. So people kind of wonder sort of why our performance is good, and the answer is because we cheat. We start with the answer and we work backwards. That's the answer. But today's talk, to make it interesting to kind of everybody, that's sort of the background of what we do and what we're invested in, and why Dave has your capital with us. There's a lot of questions swirling around the energy business that have generated sort of this group of questions, which is kind of what we're getting from everybody. What is going on with supply? Why is it tight? And and who's to blame? What's the impact of the energy transition and renewables on the conventional oil and gas business? What's the impact of government policies and regulation on the conventional business? Because remember, even though our electric wires can ship electricity made in any way, nuclear, natural gas, coal, renewables, the pipelines are built to ship hydrocarbons. It's conventional energy, right? And so the concern in any business that you have, this is Warren Buffett's like big bugaboo, is, do you own buggy whips? Do you own a business that's going out of business? And it's going to affect the valuation. It's going to affect your future growth. And all of this stress that's being created by these sort of industry cyclical factors and exogenous factors have put pressure on the companies. And you'll see that there are really big changes in how they are sort of allocating their capital dollars and what they're doing with their staffing. So let's start off with supply. This graph shows you in the blue line, global annual capital spending on oil and gas production capacity. And what we have added to it is our estimate on sort of a smoothed basis, meaning that there are cycles in the cost of the business, but the red line represents the amount of money you need to spend to maintain production and grow that production at 1% to 2% a year. So what folks outside the energy industry are either not aware of or they don't appreciate is that the oil business is so fundamentally different than manufacturing businesses. It's not a factory that cranks out widgets. So long as you keep that factory oiled and staffed, it'll crank out widgets. Yes, it needs maintenance. Yes, that widget factory will become obsolete someday. But in the short term, it'll crank out widgets. In the short term, if we stop drilling tomorrow, a year from now, the world has 6 to 8% less oil and gas. That's how fast it declines. And there's some slow stuff out there, like Saudi Arabian fields, and there's some fast stuff out there like the shale fields in the Permian Basin, which are 30, 40% decline rates, depending on the age of the well. Some initially they're 60%, and then later on in their life, they're 15 to 20, but they're much higher than 6 to 8. And so when the shale becomes a larger portion of world production, that faster decline rate starts working its way in, and that's the higher, darker red line. That's our estimate. But the point is that where the industry is spending is way below what is needed to maintain. And when you go and listen to industry consultants that do this in an entirely different way, we do this in a financial way because we're financial people. They do it in sort of an engineering way. They all come up with a number that says, you need about you need about $600 billion a year to sort of maintain production. So one of the ways to think about this is every $100 billion the industry spends is worth about 1% growth. So you need 6 of those to offset the decline and another 1 or 2 $100 billion a year to actually meet 1% to 2% growth, and the industry is spending 400 to 450. So that is why the industry is stressed for capital. The other way you can look at this, if you don't like our estimates of sustaining capital, is look at the oil companies' estimates of sustaining capital in their depreciation, depletion, and amortization parts of their financial statements. So what we do with the publicly traded companies, which are a big sample of world production, and even though they may only represent 15% of global production, they are partnered with other people who aren't public that represent another 15 to 30% of production. So it's a pretty good window into what the industry is doing, and they all kind of copy each other anyway. But what we're doing here is we're subtracting from capital spending that depreciation, depletion, and amortization from the financials, and you get sort of net growth spending, and you divide those dollars by the asset base, and you get the growth, sort of the financial growth in their asset base. And that number is 3 to 4% on average. But during the shale boom went way up to 10 to 12%. So you're growing your capital base in an industry that grows 1 to 2. Well, guess what? You produce too much capacity. The oil and gas prices collapsed. The shareholders took the credit card away. And now you're spending less than depreciation. And this started during the Trump administration. Now, that's not to suggest that Trump had anything to do with it. He has nothing to do with it any more than Biden has anything to do with it. And so I know the narrative on the opinion page of the Wall Street Journal. I read it every day, and all of this is Biden's fault, according to them. Well, if the Republicans were in power and something bad was going on, the Democrats would make everything they did their fault, or everything that was bad with what's going on the fault of their political opponent. That's the business that they're in, and it fills a lot of column inches in newspapers, but it has nothing to do with the reality of what's driving this, which is a massive capital spending cycle and a massive revolt on the part of shareholders. So if you may remember, a little over a year ago, a little activist hedge fund that owned all of 3/100ths of 1%, that's 0.0003 of the shares of Exxon, went up against management on the 4 board members that were up for renewal last year. Exxon has 12 board members, a third rotate every 2 years. And so they went up against management and they won on 3 of the 4. And everybody characterized this as an ESG thing, and I disagree, because the shareholders of Exxon are not ESG investors. ESG investors don't own oil companies. The shareholders of Exxon are just a bunch of retirees that want a dividend that grows, and they were fed up with what was happening under Rex Tillerson. And that was a lot of capital wasting. And so now the shock waves that have gone through the industry, because no one wants to lose control of their board, has resulted in the industry, in effect, shrinking its capital base 3 to 4% a year. This is historically unprecedented. So that is sort of the opportunity in the world of more supply-facing oil and gas, which affects the sentiment of our pipelines, but also creates opportunities there as well. So what about the demand side? Right. So there was this whole narrative during the pandemic that, you know, everyone knew there was a pandemic and everyone knew that affected oil and gas demand. So these graphs show you sort of the trend of oil and gas demand over the last 20 years, right? And the blue bars are the year-over-year change in percentages, okay? And oil still isn't back to where it was. We haven't made up this loss. For example, and again, it's a nice point in history because we consume and produce 100 million barrels of oil a day, so it's a nice round number. So, you know, 1 million barrels a day is 1%, 2 million barrels a day is 2%. So jet fuel demand is still 2 million barrels a day below 2019. So we're in the hole 2 million barrels a day. The Chinese shutdowns are almost 2 million barrels a day. So we are 4 percentage points on the demand side below where we were just 2.5 years ago. And so, you know, we're having these big hits to demand at a time when supply and demand is tight. And why is supply and demand tight? Well, because of the graph I just showed you on the supply side. So you say, okay, well, that's a short term, but in the long term, we've got electric vehicles and alternatives that are just going to basically put these guys out of business. And that was the narrative. And so, you know, no matter what you read, no matter what, you know, what kind of newspaper or financial press or whatever, it was the end of the oil and gas industry. And what people were reacting to was the rapid growth in wind and solar, which resulted from a 90% drop in their costs over the previous 10 years. This has created numerous opportunities for us in our portfolio, but just because it's an opportunity for an investor doesn't mean that it is fundamentally changing the industry. Is it affecting the industry? Absolutely, but not to the degree that people think, because it's starting at a very small base. And we'll go through that in a second. But let's start with oil. So the narrative just 2 years ago was that renewables were stealing share from oil. The problem with people who wrote that is that they don't know what this pie chart looks like. And the pie chart tells you what oil is used for. And you can see that about 55% of oil is used for transportation. And this is global, not just US. And this is a big change from just 20 or 30 years ago. Now, the number in the US has always been, not always, but in the last many decades, has been a high percentage transportation. But in the emerging markets, a huge percentage of oil was just, you know, heating oil, space heating, and things like that. But as the global economy evolves, over 55% is now transport. 15% is petrochemicals, which still grows faster than GDP and has nothing to do with energy. It has to do with materials, right? Plastics substitute for more conventional materials like glass and ceramics and metals and things like that, right? Because you just look around your house and around your car, right? What they're made of today versus what they were made of 30 years ago. And so electric power, which is what renewables produce, is only 4% of a barrel of oil. So to say that renewables are stealing share from oil is nonsense. It's nonsensical, because oil isn't used to make electricity, okay? So the threat, however, to oil is electrification of the transportation system. And while people are talking about it for trucks and talking about it for non-road, which is airplanes, trains, and ships, it's really only happening on the passenger automobile side. Now, the problem is that the data you're seeing is the percentage of new car sales that are electric. that's a much different number than the percentage of the on-road fleet. And the problem with people on Wall Street is they all make a nice living and they all get a new car every 2 or 3 years, and they don't drive in neighborhoods or visit countries where cars are 30 years old. But in fact, the turnover of the global fleet is only 4% a year. In other words, the scrappage rate is 4% a year. So 1 over 4% is 25 years. And so when you look at the size of the on-road fleet today, it's almost 1.4 billion automobiles, right? And we produce, only, well, the way to say it is we produce 4% of that number every year to replace the scrappage, and another 3% of that number to provide for the growth, because this on-road fleet is still growing at 3% a year, not in the US, not in Europe, but in China and India and places like that, it's growing 6 or 7% a year. So the global average is still 3. And so when you look at how long it's going to take for electric vehicles, even if they were 100% of sales starting tomorrow, it would be 25 years before the on-road fleet turned over. And that's just passenger cars, which are only a quarter of demand for oil. And so you haven't even started on the trucks and the trains and the planes. And of course, you're not going to address petrochemicals and these other demand with electric vehicles. So the other way to think about it is to look at separate new car sales and what portion of them are electric vehicle, which is what we've done in this upper graph. And we have made simplifying assumptions that are, quite frankly, ridiculous. We are assuming in this analysis, just to run the numbers, not a forecast, it's an exercise that says that in 2030, what if 50% of new car sales were electric, and in 2035, 100? There is not a single consultancy or Wall Street firm that's forecasting that quick of an adoption. But if the adoption was that quick on the news, look how slow it would be on the on-road fleet. So by 2035, still only 45% of the on-road fleet would be electric. And remember, what you're doing is you're cutting in half that demand for what is only 25% of oil demand today. So you've hit oil demand by 12 percentage points in 2035, while all the other sources of oil demand continue to crank along. That's the difference between sort of the narrative you see in the press versus the sheer arithmetic once you model this out. And these graphs come off in an enormous spreadsheet with a lot of detail on it that I'm sure no one else on Wall Street has done. I think people in the Department of Transportation have a spreadsheet like this, but no one on Wall Street. I've been doing fleet modeling since I was an analyst at Bernstein, because this is one of those things that everybody misunderstands. How about natural gas? Natural gas does compete with renewables. Now, there are some estimates that are as low as 30% of gas being used as electric. This data source is 40. And again, we're just going to kind of demur to sort of the worst case scenario for hydrocarbons just to kind of make the point. And you can see that there's a lot of other demand for natural gas. And so gas does, in fact, compete with renewables, but it also competes with coal. And so for every percentage point that shifts from natural gas, coal, and nuclear to renewables, it's almost a 1-for-1 hit to coal, which is virtually, except for metallurgical coal, is used essentially to make electricity. But for natural gas, it's only 30 to 40% of its demand. So again, these other non-electric power generation uses of natural gas are not being affected by wind and solar. And so in fact, what you've seen happening, and less so in Europe this year, because obviously Russia has basically cut off its gas supply to Europe, right? So we're in the middle of an anomaly here. But the trends in Europe and around the world are the same as in the US, which is that the loss in market share is happening from coal, and it's being replaced by renewables and natural gas in the US. And part of this is due, most of it actually is due to cost. Remember, the cost of renewables is down 90% over the last 10 to 15 years. The cost of natural gas is down because of shale. But more importantly, from a mechanical and engineering standpoint, that natural gas power generation balances the intermittency of wind and solar much better than any other source, because it's a turbine and it can be cycled up and down just like a jet engine. It's very hard to do that safely and not hurting the machinery with coal, and you pretty much cannot do it with nuclear. And so natural gas has been growing in the US and overseas, not shrinking because of renewables. So the narrative is just kind of wrong. And so when you back up and look at this from the top down, one way to think about the world GDP is that the world invests sort of 13 to 15% of its GDP every year in energy, which drives the other 85%, right? Think about how the world economy works. It's not humans and animals providing their mechanical labor, which is what happened 200 years ago and then farther back in time, right? It's machinery that humans built that does the work for humans and needs energy to run it. So a machine can do the work of 1,000 men. Why? Because it is capturing energy and it's making a lot more widgets than those humans could do without the machine. And so GDP does not grow without energy. And so when you think about the risks to, primary energy demand from a recession, you have to kind of ask yourself, is the recession not in part being created by a shortage of energy? Because if you take energy away from the economy in the short term, you shrink the economy. It's that simple. Energy efficiency moves forward over time, but it's slow and it's glacial. And yes, 20 years from now, we'll be generating a lot more GDP from every BTU of energy. But between now and 2 years from now, it's effectively not going to change. So if you take energy away from the world economy, the economy shrinks. And so I think a lot of the questions about the recession affecting, energy demand are to some degree reversing cause and effect. But if we look long term and say, okay, the world GDP is going to grow at 3% like it always has, and that means energy demand is going to grow at 1.5, because you can see that's about the ratio. And certainly that ratio is declining because as the world economy gets more service oriented, as Alan Greenspan said, and our GDP gets lighter every year, right? So, but if we assume 1.5%, and this is where we get our primary energy today, 82% from fossil fuels. Even if renewables are growing at 15%, we still need natural gas to grow at about 1.5% a year just to meet the energy balance. And so what this table does is it shows you in 2021, the sources of energy for the planet, primary energy and where it comes from. And renewables are only 7%. Now, hydro is renewable, but it's not really growing because we're kind of running out of rivers to dam. And assuming it's growing at 15%, which by the way, it's not, we actually spent a lot more money for renewables grow 15%, but that's sort of the target. So let's just assume it's 15%. Let's not get involved with arguments about supply chains. Let's not get involved in arguments about national security and how all the solar panels come from China. We don't just demur to the argument, okay? Yes, it's going to grow 15% a year, no problem, right? And people say, well, it's not true. Just stop. Assume it's true. And what does that leave for other sources of energy to balance this required 1.5% a year? And hydroelectric can only grow about 1.5% because of the availability of rivers. Nuclear is shrinking because we're closing the plants, okay? Coal is shrinking because it's losing share to natural gas. We saw that in the United States. And yes, it's up this year because of the Russian thing, but it'll continue to lose share and actually fall in real terms. Oil is driven by our transportation model. And what that means is unless gas grows at 1.5% a year, you can't make the world's energy balance happen. So whether you look at it from the bottom up and look at who's stealing share from whom, or whether you look at it from the top down, you really can't get to a conclusion that says oil and gas demand are not higher 10 to 15 years from now than, 10 to 15 years higher than they were pre-pandemic. It's just, you just can't make the math work in spite of our sort of assumptions about renewables growing faster than they actually are and electric vehicles being adopted much faster than they possibly could. So how about regulatory and policy risk? So, again, there's this whole narrative about, how this is the Democrats' fault and it's Joe Biden's fault. And I have a friend in Florida who says, so it's just a coincidence that gasoline price went up when Biden got elected. And it's sort of like, you realize that the energy business is a global economy, right? And you realize that, only that federal lands provide only 10 to 15% of US oil and gas production, which is only sort of, 20% of global production. And so when you do that math, you're talking about a lack of growth in the future, okay, not in the past, in the future on what is 2 or 3% of global production, right? So by definition, one had nothing to do with the other. It's just the math of how the industry works. But even coming out of the Biden administration are two pieces of legislation that are more friendly to conventional energy than anything that comes out of the mouths of the current occupant of the White House. Remember, this guy, when he campaigned, said that he was going to put fossil fuel executives in jail. Now, I don't know what crime he thinks they've committed, but it was a good, it's a good stump speech. He's just preaching to his choir, and that's the nonsense that came out of his mouth. It's nonsense that comes out of all people. He can't be a politician unless you're willing to spew nonsense in front of the microphone. But when you look at what actually happens, there was all kinds of subsidy in there for conventional energy. I mean, they increased by a dramatic percent from $50 to $85 a ton the tax credit you get for capturing and sequestering carbon dioxide. This is going to trigger a huge industry in this country over the next 5 to 10 years. That is a direct subsidy to fossil fuels. It allows fossil fuels to be clean. When you look at the both the bipartisan infrastructure bill and the Inflation Reduction Act, and you go through it line by line and look at the allocations, you'll see how much actually goes to conventional energy, including nuclear. In fact, the subsidies that renewables get, and remember, the wind and solar guys are entrenched, political operatives at this point. And to subsidize something that is now the cheapest way of making electricity, of course, doesn't make good policy sense. But there's a lot of things that don't make good policy sense. It's all about politics and political contributions, no matter what industry you're talking about. But what was different about the IRA was they took half the money that would have been allocated to renewables and allocated it instead to clean energy. That's any zero carbon use. And so there is a technology out there we're very familiar with called net power. It's a single stage gas turbine that combusts pure oxygen rather than air. And its effluent is water and carbon dioxide. And they recycle that carbon dioxide to make the turbine more efficient. And it is a technology that is zero carbon and competitive without any tax credits. You throw in the $85 credit for carbon dioxide, it would be the cheapest form of electricity on the planet. That would qualify for an additional clean energy credit. And so that wouldn't have happened 2 years ago. Another thing that wouldn't have happened 2 years ago was the European Union that has this whole taxonomy of what businesses are sustainable and what aren't, sort of like who's in and who's out, who's in the cool crowd in school and who's not. The EU, after 6 to 12 months of debate, decided that natural gas and nuclear were actually sustainable businesses. And this was a huge debate between the pro-nuclear countries like France, where 80% of their power comes from nuclear, and Germany, which has made a big thing about shutting down all their nuclear power plants. And so it's sort of like rock and roll versus disco. And, they're going to fight for the end of time. But at the end of the day, the nuclear natural gas guys won because of the political importance of making sure the energy system runs. And the other way to look at this is ESG investing, right? So Larry Fink, who's always sort of playing defense on what he says about ESG, Larry Fink is the head of BlackRock, which runs $7 trillion. They're by far the largest money manager in the world. Most of it is indexed. And he said, look, the S of ESG stands for social, right? And if you've got the poor people in the world that can't afford to heat their homes, you have run in trying to maximize the E of ESG, you have slammed into the wall of the S. And in a minute, we'll get to the G and talk about what the companies are doing with corporate governance. But there has been a huge shift in sort of the balance of what is being politically favored, both in Europe and in the United States. So it's much different than I think people get when they read the financial press, or they looking at, they read the New York Times or Wall Street Journal. No matter what you read, you're seeing an extremely biased version of what's going on. So let's talk about the governance. Let's talk about how the conventional oil companies, and this affects the pipeline companies that we own as well, because the only thing that can hurt you in a commodity business is too much investment in anticipation of growth. And that's what hurt a lot of these companies, both pipelines and conventional energy, over the last 10 years. And when you invest in a commodity related business, you want it to be starved of capital, not overfed. And look at some of these statistics that are on this page. Capital spending down 58%, employee count down 15%, SG&A down 19%, exploration expense down 70%. That's what you spend on exploration. Now, you don't really explore for shale. You already know where it is, but outside the United States, you're still exploring. And this stuff is expensed, not capitalized. And so it directly affects the P&L. And then look at what the top 5 international oil companies are doing with their capital structure. Okay, this is Shell, Exxon, Chevron, BP, and Total. And these guys, over the next 5 years, this is through company guidance and analyst estimates, are gonna pay down or buy back 21% of their stock. They're gonna pay off all of their debt, 107% of it actually. So the outside capital is gonna be down 29%. Shell is even more extreme. So you look at the end of 2021, 35% of Shell's financing was debt. We call it enterprise value. So 65% was equity, 35% was debt. By 2025, they will have 0 debt outstanding, and they will have bought back 25% of their stock. So in effect, Shell is paying off 50% of its external financing in 5 years. I don't know of any large company in history that is paying back that much of its financing. That means whatever profits they make will not be diluted by interest charges on the one hand, and will be divided by 25% fewer shares. This is kind of what the market is missing. And the pipeline companies are starting to do this too. One of our biggest pipeline holding companies has bought back 9% of its stock in the last 2.5 years. And so there is a huge change in the attitude. These guys do not want to happen to them what happened to Exxon, where they lose control of their board, and because at the end of the day, it's not their company, it's the shareholders' company. And so, you know, the shareholders give them wide latitude, but their returns on capital employed went from about 10% in the industry 20 years ago with $27 oil to nearly 0 with $55 to $60 oil. That's how much value they destroyed, and the shareholders got fed up and took it away. And so there's a lot more capital spending discipline, which is good in a commodity business, whether you're in the upstream, the midstream, or the downstream part of the business. So I'll finish up, Dave. Just a summary, the supply shortage is really driven by these industry factors, not by politics. And that's very important from a policy, from an investment standpoint, because if you think that changing out the person in the White House is going to make a difference, then you would have a 2-year time horizon on your investment in this. Whereas if you see it based on what actually caused this situation and how long it will take for the industry to dig out of its capital spending deficit, it doesn't matter who's in the White House. It doesn't matter who controls Congress. This is a dynamic that has nothing to do with that. Does it affect it on the margin? Yeah, but it's mostly cocktail party talk. Okay, we deal with math and numbers, and this is a capital spending cycle that is the biggest one really since World War II that we can find. So oil and gas demand, you know, these stocks are being priced as if they're out of business in 10 years. And in 10 years, we're going to have higher oil and gas demand on the planet, almost no matter what happens, than we had pre-COVID. And maybe 15 years from now, you'll actually start seeing oil and gas demand start falling off. I don't know of anyone that has a 15-year time horizon, not even Warren Buffett. And what's he doing with his capital? He's investing more in oil and gas companies. The government policies, yeah, there's risks there, but when you're as close to it as we are, we see this stuff coming a mile away, and it creates opportunities, not just risks. And really, at the end of the day, what matters is how these managers, because remember, they're not raising capital, they're paying back capital, what they do with their cash flows. That has everything to do with whether or not these are good investments. And we're in a period of time now where, you know, they got smacked. I mean, think about like a freshman in college who's just like not going to class, and, you know, he's using all daddy's money to get drunk on Saturday, then daddy pulls his card away from him, right? Now, he's not, when he talks to his friends, going to blame his own bad behavior. He's going to blame something else. So the industry is embarrassed on how much capital it wastes. So of course, the industry is blaming somebody else, but it is the industry's fault. It's always the industry's fault. It's always management's fault. And so when they whine and complain about being at some, you know, someone else being the cause, you know, you don't have a good management team. Good management teams take responsibility for their own actions. And so this is an opportunity for those guys to point the finger elsewhere when in fact it was them that screwed up to begin with.
Good. That's a great summation of the energy industry as we think about oil and natural gas. What I'd like to do, and I know a lot of people joined the call late, so I'm going to give you the ticker symbols again that Jim manages for our clients. It's ECLN, I call it eClean, and I'm going to ask him to comment about that. EMLP and FIF are the three that we use. Jim, tell us about eClean a little bit. Now, it's not really clean energy. It's companies that are reducing carbon, correct? Could you kind of give us your handle on that and why it's really a big growth area? Maybe even talk about next era energy, which I know is a big part of all your portfolios, as a classic utility example.
Yeah, so as I mentioned at the top, utilities are regulated monopolies, in return for being granted this monopoly, which is you could say is in society's interest, because it's a waste of society's capital to have 3 sets of poles and wires running down every street. You should just have one, but that creates these other problems. Right. So that's why they operate under regulation. And even though the regulation provides an allowed rate of return, there are management teams out there that find a way to screw it up. And history has demonstrated that over and over and over again. So picking the right management teams is everything. And so when you operate the poles and the wires, you're sort of have the pole position. You are sitting at the center of the energy system, and you're not in the position of having to risk capital on a new fuel cell technology or a new battery technology. You have the luxury of having those guys fight it out in the ring. And just like the emperor, in Rome, you can do thumbs up or thumbs down. And it's not your neck that's at risk. The capital markets are willing to take risks and try new technologies. And when the new technologies that survive that battle sort of, present their products to the utilities, if they're lower cost, if they're more reliable, if they're cleaner, if they're safer, they're going to be adopted. And the utilities then will have to invest capital hooking up that new supply or that new device that makes the grid more reliable or safer, or just a typical capital for labor substitution, which is, kind of what the modern world is all about. And so, that provides the growth opportunity, because if you get an allowed rate of return on your invested capital, you grow your earnings when your invested capital grows. That's why you got to keep an eye on management. There's management teams out there that will put capital on the ground that's not needed, thinking they're doing the shareholders a favor. And it's going to seem fine for a while until the regulator says, you've run your costs up too much. We're going to start disallowing a return on some of your investments. And the industry has seen this through the cycles. So the trick from an investing standpoint is find the right management teams that understand how they can deploy capital to make the energy system they're responsible for cleaner, cheaper, safer, more reliable. And so we are like a broken record. So when we're at the Aspen Institute and everyone says, oh, it's about the carbon, stupid, right? Remember what Clinton said when he was about the economy, stupid. And there's someone at the Aspen Institute, there's only a small group of people, it's like 60 people. We can see some people kind of change out, but 40 of the 60 people are kind of the same. And there's one person there that says all the time, it's about the carbon, stupid. And he said this in the last session. And there was a regulator there from a state. She was head of the entire regulatory system in her state. And she said, no, it's also about the reliability and the cost. She's a Democrat. She's a liberal Democrat. And she's a liberal Democrat environmentalist. But she is responsible for the safety, reliability, and cost of that system, as well as its environmental impact. And so I've never met anyone who's not environmentalist. I've never met anyone who wants dirty air and dirty water. The question is, what does it cost? And you cannot run down the reliability, run up the costs, and make less safe the energy system just because you want less carbon. And so when we had our high net worth investors come to us and ask us to do an impact fund, our first comment was, what's an impact fund? Is that like ESG? And they were like, no, it's nothing to do with ESG. It has to do with people who are trying to do impact investments in addition to their charitable contributions. That's what impact investing is all about. You guys do this already. You're engaged with regulators, you're engaged with policymakers, you're engaged with the management teams, you understand this. And we said, okay, you understand, we're going to fail on ESG. So they said, oh, we don't care about it. They said, okay, because no one's telling me how to run the portfolio, not MSC, not Morgan Stanley, Sustainalytics, none of these consulting guys. I don't want to hear it from anyone that we have We have a low ESG score because we own a utility that produces electricity from coal, but they have a 10-year plan to reduce that and lower costs and make the system more reliable and make the system safer. Because remember, it's not just carbon that coal plants emit, it's other things too. It's mercury, it's other heavy metals, it's ash, it's things like that. You know, people have been complaining about what comes out of a coal plant since the 1600s when they started burning it in London. You can actually go back and read what people wrote. Country gentlemen would come to London for a week and complain of it. It would take them 2 weeks, you know, back in their farm, you know, back in their country estate for their health to feel better. This is not sort of a modern environmental issue, right? And so, you know, at the end of the day, we said, we'll do it, but we're going to do it the way we want, which is good management teams have better track records on cost and reliability and environmental impact and safety, as well as returns on capital. That's what we do. And that was why we agreed to do sort of an impact strategy. And, you know, if you go back and, you know, you can get our testimony that, you know, I sat in front of the Senate Energy Committee, and I pretty much laid this out. And since it's a felony to lie to Congress, you can pretty much bet I was telling the truth as I saw it. And we're pretty adamant about this, especially the safety thing too. So it really irritates me when people are willing to sacrifice safety, cost, and reliability. I understand, look, pollution costs money to clean up. I get it. But you can't sacrifice reliability and safety of a critical system like energy or the water system or the transportation system for one factor versus the others. And so that's where eClean came from. And it really is a subset of our portfolio. And it's very sort of utility heavy, because when you look at the reduction in carbon emissions in the United States since the peak in 2005 to 2007, that 17% reduction comes almost entirely from the electric power sector. So essentially 90% of the carbon emission reductions has come from an industry that makes up 3% of the S&P 500. That to me is the definition of impact. And in my view, it is a lesson for policymakers, and if they want to leverage private capital to make the system cleaner, cheaper, safer, more reliable, they should look at what the utilities are doing, because they're the ones who are doing it. Everyone else is just talking about it.
Mm-hmm. So,
and most of those people are willing to run up the costs and run down the reliability to do it. Exhibit A, California.
Right. Well, speaking of California, so let's first of all, how much of that is a simplistic? How oversimplistic am I being, saying most of that is coming from moving from coal to natural gas?
It's 50-50. So when you do the math from that graph that we had, it's exactly half of the carbon emissions are natural gas versus coal, and half is, you know, less of anything and having zero emissions from wind and solar. And so the gas guys like to take credit and the renewable guys like to take credit. And it's like, guys, it's about 50-50. So. Good.
All right. If you have a question, then please hit the chat and we'll look at that. Let's go ahead and go to one real quick here. Considering that energy is one of the major foundations of any economy, and obviously when we think about that, trucks, transportation, bring everything to our houses, everything along the lines. Yeah. I'm trying to shorten this question a little bit. It's become politicized, and are there any efforts by groups of people, industrial and political, to attempt to manage the current energy type and use to transition in a more rational way toward the, you know, solar, wind, and others, without the forceful and dismissive use of the current energy, as you've been talking about, and the social engineering that causes? Are there any groups really trying to, bipartisan, if you will, okay, take this from a political issue into, this is about energy, period, end of story, right. Okay?
So there's two things. So the answer to that question is yes. If you look at the Clean Air Task Force, which is an environmental group, they came out with a report that said, here's what's going to happen to the cost of electricity in the US and in California as you go from 20 to 40 to 60 to 80 to 100% renewables and batteries. And the answer to their analysis, and they assumed that cost of batteries would get cut in half. The answer is that the wholesale cost of electricity goes from 5 cents a kilowatt hour to $1.50. 30x, And so this is not the American Petroleum Institute that did the study. This is a Clean Air Task Force and a guy named Armin Cohen, who we know, who's just brilliant, by the way. And his concern is that if environmentalists don't understand the cost and reliability impact of what they're talking about, they're going to lose their political clout. And so, again, they're an entrenched group, just like a lot of other industries are, because they're big now and they employ a lot of people, mostly the people that put solar panels on roofs. That's where the labor comes in. And, politicians will run for cover if the trains aren't running on time, if the electricity system is breaking down. And so he's concerned that if you really want to get carbon out of the system, because it's a risk to the climate, okay, and that's sort of how I see it. It's like, I get tired of listening to climate alarmists, and I get tired of listening to climate deniers. At the end of the day, the greenhouse gases warm the planet. The issue is the feedback mechanisms, and the feedback mechanisms are everything, and they're enormously complex, and no one has completely modeled it. And so there is no way that environmental disaster is 100% assured, and it's no way that it's 0%. It's somewhere in between. And so you have to understand that, and you have to say, well, how are we going to deal with that? And the answer is not taking away an existing energy source before you have something to replace it with, in spite of the fact that a lot of people that get time at the microphone actually suggest that. And so that's one environmental group. Now let's talk about what happens in Washington and in state capitals behind the scenes. Okay, so this is the benefit of us having this dialogue, for example, with the Senate Energy Committee. When you go from listening to a politician on TV or what he or she is saying in an interview to having a discussion with staff members, it's like transitioning to a parallel universe. When you meet with most of, actually my experience is most, and I mean like 90% of these staffers, you are meeting some of the smartest, hardest working people you will meet in your career, and they are apolitical. The only political bones in their body are either A, because they want to be a politician someday, which is like 10% of them, but the fact that their boss is a member of one party or the other, and they have to accommodate that. But during their day job, they have to make the system work. And so a great story from during the Obama administration is when Enterprise Products, which is one of the largest pipeline companies in America, one of our largest holdings, got called to the White House. I'm going back, this is Obama. So we were going back 8 years now, 7 years. And they didn't tell them what they wanted. So they get up to the West Wing, and they say, guys, what do you want to talk about? They thought they were like getting called into the, the woodshed. And they said, well, yeah, we understand you're building a pipeline into the Bakken Shale in North Dakota. They said, yes. And they're thinking, like, what's coming next? They say, well, how's that going? And they say, well, it's going fine. We're getting commitments. We're, getting, leases for the pipeline easement, that kind of stuff. Why do you ask? And they said, well, we just want to know if there's anything we can do to help you. And they said, I'm sorry, what? We want to help you build the pipeline. Really, why? Well, because as you know, most of that crude is being shipped on rail. It's clogging the rail system. And all the farm state senators are really frustrated that their corn and soybeans can't get to market, because the rail system is clogged. So we're just calling you up here to see if there's anything we do to help you. Now, that's the last thing Obama was going to do when he got in front of a news, in front of a news conference. But that's a great example of what goes on behind the scenes that makes the economy work every day. But then when people get on the stump and get elected, they're just preaching to their base to make sure that they turn out for the election. So both of those stories, whether it's the Clean Air Task Force worried that, if you screw up the electric system, you're gonna lose your mission of trying to clean up the environment. Or if you're a staffer and you're just trying to make the system run every day and you have to deal with the staffers on the other side, you have to deal with industry. Economy is a very complicated thing. There are a lot of rules and regulations, which, by the way, most of them put in place by the companies, not by the government. They've been asked for by the companies because it makes the system work, because the alternative is taking everyone to court all the time. When you get into that world, you realize that it's a heck of a lot more pragmatic than what you read about in the papers. And when you go through, and I know it's tough, look, the summary of the bipartisan infrastructure bill, the summary is 180 pages. That's the summary. The damn legislation is 1,300 pages. And I myself have not read it, but I read all 180 pages of the summary. No one's going to read that. But when you go through it, you see how much more balanced it is than the narrative. So be optimistic. If you meet any of these staffers that I deal with, you will change your view of sort of, how things will be going forward. It's don't think that all of Washington is like the few who are elected, because of every elected official, there's literally hundreds of people behind the scenes that make the thing work every day.
That is an optimistic statement. It's good. I mean, we think about that today, the Keystone Pipeline. First thing we do is shut it down. That doesn't sound like the right thing to bring more energy.
No, but it's great politics, though. I mean, this is TransCanada is the company that's sponsoring that, and they have a new CEO who we don't care for as much as the old CEO, who we're very close to, Russ Girling. And we were the largest shareholder of their U.S. subsidiary, which was created as an MLP. And Russ Girling we thought was great, and he retired early. And if I had any say about it, he'd still be in that job. I'd find some legal way to make sure he didn't retire. But every time we met with him, we'd say, Russ, just shut the project down. And he'd say, why? And I said, because you're gonna lose. He says, oh, run the numbers. I said, Russ, you can run the numbers all you want. There are people that are gonna come out of the woodwork because they will be financed, because this is a lightning rod. And so during the Obama administration, the Keystone Pipeline attracted all the attention. But meanwhile, literally tens of thousands of miles of pipeline got built during the Obama administration. And so there's a difference between the business of getting elected and the business of governing. And Keystone is a great lesson in that. And so as an investor, I don't want him doing that, because he's going to waste my capital, because it's just become such a controversial issue that you're going to lose. Just let them have that win and go ahead and run your business. Stop butting your head against the wall. And it's like, well, it's the wrong thing to do. It's not the right for the country. And it's like, look, that's not your job. You're a CEO. You're investing my capital. Your job is not to make the world safe for democracy. Okay, just let's understand what your job and my job are, and let's fight that battle in another place and at another time. And at the end of the day, the system will work. But don't get out there and embarrass your political opponents. It doesn't get anything done. If you want to get stuff done, de-escalate it.
Is that going on now, the last couple of years? Do we have other pipelines that are being built? We all famously know this one got shut down. Are they doing that? And then let's have twofold here. So we hear from the energy companies that the leases they have, yes, but they're not being permitted. And there seems to be data saying that is true, that they are not permitting them. The administration says they are permitting them. They're just not using them. What is the truth that's happening, if you will, to take that analogy, behind the scenes with A, pipelines, and B, with actual production?
So let's start with the production. So, we met with a bunch of companies at the Barclays Energy Conference in September. It's the biggest energy conference of the year, and not a single CEO said access to permits was a problem. Not a single one. Okay, but remember, they're all members of the American Petroleum Institute. They have a message that they have to do. So it's sort of like, if you're running for Congress, you have two choices. You can be a Republican or a Democrat. And if you don't toe the line, they won't finance your election. I mean, at the end of the day, you're a grade 12 employee of one of those two political parties. That's the deal. That's the money. And so these oil companies, when they are asked to speak on the part of the industry, they toe that line, or they are not welcome at the Petroleum Club in Houston. Okay, there's a social element to what they're doing. But when they talk to investors, they're telling you what's actually going on with their business, which is they are constrained in their manpower and their rigs. That's the constraint, not the permits. Are there some examples of that? Absolutely. But look, you saw that capital spending cycle. Permits had nothing to do with that.
Mm-hmm.
They have been underspending their depreciation since the Trump administration. Was Trump, responsible for that? That would be absurd to say that. And so it's absurd to say Biden is. It's just political cocktail party talk. There's a difference between that and getting elected and investing. And that's what we do. We invest and we care about the numbers. And so now let's talk about the pipelines.
Yep.
The pipelines is less a regulatory issue. So here's the other thing. When we have these discussions with investors and financial advisors, what we find is 80% of what we're talking about is a civics lesson in how things actually work in government. And we don't teach civics in high school anymore. We just don't. So people in this country do not know how their own government works. So let's take, for example, the offshore lease sale. Offshore lease sale, I think it was number 273, I think is what it was. And it was 80 million acres in the Gulf of Mexico, 2 times the size of the state of Florida, by far the largest. And when Biden said he wasn't going to do the lease auction, he was sued in federal court in the Western District of Louisiana, and he lost by summary judgment. Why? Because it's not the president's prerogative to do that. Congress lays out the rules on leasing and how much gets leased every year, and the president executes it. That's why it's called the executive branch, not because he's the CEO, because he does what he's told by Congress. That's how the Constitution works. And so when you look at pipeline regulation, if you can demonstrate need for a natural gas pipeline, then, the Federal Energy Regulatory Commission has to give you a permit. And with that permit comes the right of eminent domain. But it doesn't mean that the Sierra Club can't sue and say that some permit that some government agency like the Army Corps of Engineers or Fish and Wildlife is not adhering to the rules that Congress laid out on what these permits have to show and not show. And so when you look, for example, at Mountain Valley Pipeline, which is the one that's 95% complete, trying to get natural gas from the Marcellus down to sort of the middle Atlantic coast, when you look at the facts of that case, Army Corps of Engineers, Fish and Wildlife, Department of Interior, they were really sloppy in doing these permits. And so these pipelines are being held up in court. They are not being held up by the legislature, and they're not being held up by the executive. We have 3 branches of government. It's the right of anyone to sue when they think that something that the government has approved is violating the very rules the government laid out to achieve that approval. We are a nation of laws. And so I don't want to live in a country where people don't have the right of redress to the court system. People say, well, it's a national security issue. It's like, I get it. Okay. But do you want to live in China and Russia where the government says those buildings are getting knocked down because we're widening the boulevard? Do you want to live in a country like that? I don't. And so the oil companies and the gas companies and the pipeline companies need to learn how to follow the rules of the law and get through these court cases in a way that's going to get the pipeline built. But instead, they whine and complain about it rather than just go and do their job. And when you see the really well-managed companies like Williams, they engage these folks before they ever have a problem. So the great story that comes out of Williams is they were trying to build a pipeline across the state. And of course, the state of New York was the problem in this case. So I'm not saying that all jurisdictions are good. I mean, Andrew Cuomo had these ridiculous laws, and the Northeast, doesn't want pipelines, and now they're suffering for it. It's like, hey, it's a democracy. That's what they voted for. Let them suffer. But Williams wanted to make sure they could build this pipeline, and they're getting all their permits and everything, and they wanted to make sure that the pipeline wasn't inadvertently going through sacred lands of any Native American tribes. And so they went to Native American tribes, and this is what we're trying to do. They held a convocation, and they said, we will spend whatever it takes for you to research this easement and make sure there are no sacred burial grounds or any sacred grounds that we're going through. Whatever cost, send us the bill, we'll pay it. They came back and they said, you're good to go, until the Narragansett tribe, which is, you can just tell by the name, is from Rhode Island, which is nowhere near this pipeline. They got some money from the Sierra Club to come in and object.
Huh.
And of course, the court says, you don't have standing because you don't have, there's nothing here. But that's an example of a really well-run pipeline company reaching out to the people whose land you're going to take and make sure that you're following the rules. And then you look at a company like Energy Transfer, and they just, when they had the thing up, with their pipeline out of the Bakken, when there were protesters, they hired the sheriff's department to fire water cannons at them in the middle of the winter. That's not exactly public relations 101.
No,
so you don't strong arm people. You can get, we are a system of laws. Yes, there's bad courts, there's bad judges, there's bad legends, all that stuff. But you knew that before you started to build a pipeline. And I'm a shareholder, and I don't want you going up into a jurisdiction that you haven't researched, where you don't have a good chance, and you're going to spend $200 or $300 million before you realize that you're going to have to cancel this pipeline. In some case, those numbers are in the billions. And so at the end of the day, if they're wasting capital, it's their fault, not somebody else's, because, you know, the situation is what it is. And you got to remember, as crazy as all this stuff seems, we in the United States have the cheapest, most reliable, cleanest energy system in the world.
Except for California.
So it's, you know, so it's like what Winston Churchill said, you know, Americans always get to the right answer after trying and failing all the others first.
Yeah,
And remember, his mother was American, and so it was a compliment as well as a criticism, and that's how our system works. And, you know, I don't think you want to live in any other system, and people have the right of redress, and they have the right to have their day in court. And all this stuff takes time. There are things you can do to streamline this stuff. That's what Joe Manchin is trying to do with his Energy Security and Independence Act, Phase 2. The first act that was passed with that name was in 2007 under Bush 43. That's the legislation that got you LED light bulbs, by the way. You know, there are things you can do to streamline the system. There's no question about that. People will, anyone will abuse the system if it serves their purposes. That's since the beginning. I'm sure they were doing that back in ancient Rome, but you know, that's not new. And if you're gonna run billions of dollars of shareholder capital, then you got to approach it the way Williams approached it. Do it right or don't do it.
Good. Do you, is there a positive role for ESG reporting in the future? If so, how? And if not, why not?
He said, from my perspective, the more information I can get for free, you know, I'm Scottish on both sides of my family. So if it's cheap, we buy it. If it's free, we take it. That's our credo. That painting our face and drinking and getting into fights with people, that's kind of what white people do. And ESG reporting is all else equal good. Now, there's a lot of ESG reporting that's a waste of time and is stupid. Everybody knows that. But it's early on. Hopefully the stupid stuff gets flushed out of the system. We try to play a role when we can in terms of our dialogue with our management teams. So if they feel they're under pressure from ESG investors to either do something or report something that literally makes no sense, so we have a voice, you know, to say, look, you know, that doesn't make any sense, not for this industry. And so it's very early innings in the ESG thing. My personal view is divesting of publicly traded equity doesn't really accomplish anything, because you're not taking away capital from these people. The whole idea that by selling your shares in Exxon, you're taking money away from Exxon is silly, because they're perpetual securities. It's not like an open-end mutual fund where you redeem, they have to sell securities to give you your money back. This is like a closed-end fund. You're just selling your shares to somebody else. You haven't affected the behavior of the company. So if you want to affect the behavior of the company, you need a seat at the table. And again, let's go back to engine number one with 3/100ths of 1%. They had a seat at the table, and they had an argument that carried with a lot of people. And, you know, Exxon, you're wasting capital. That's how the argument started. They kind of shifted towards an ESG kind of tilt to get more votes. But what politician doesn't tilt his story to get more votes? That's just the human condition. And so I get it. There's a lot of waste, but I would rather have more information than less. And we've had some pretty frank conversations with our management teams on things like political contributions to dark pools. We've had that conversation with NextEra. So we're a big shareholder in NextEra. We're a big shareholder in NextEra Partners, and we've had that difficult conversation with them. And you know, just we tell them to cut it out. Mm-hmm. It's just going to come back and bite them. Don't tell me you have to do that to do business, because we know utilities that don't do that. And right. You traded a rich multiple for good reason. And so watch it. And so all the ESG reporting helps us on having those discussions.
Good. You talked about the tight pool, because we have so many people that own the fund FIF. Would you, there is a little bit of leverage on that. I believe it's about a third. Is that variable? Is it fixed? And how close is it to your EMLP in your management style?
It's very close. The difference, we you know, our different portfolios are all different column in the same spreadsheet. And so the model portfolio for FIF and EMLP are very similar. The difference would be a little bit more biased towards income. in FIF than EMLP, because FIF has sort of a, a dividend we're trying to promise, whereas EMLP, just being a negative mutual fund, it is what it is. But otherwise, it's essentially the same strategy. And so the leverage is roughly 20% of gross assets, which, as a percentage of NAV, as you know, is a bigger number. But that's, so we run modest leverage in that. And
do you ever pay it down with rates rising?
A lot less than the other guys who run closed-end funds.
Right. Well, you didn't run into the trouble they did when the MLPs blew up either.
No, they just, And I mean, you look at someone like Kane Anderson. I mean, Kane Anderson has lost 85% of their assets under management, and Tortoise has lost 2/3.
Yeah. No, they deserve it. They blew up everybody's money.
Yeah.
So what, with that though, are you paying that down, or do you keep a lower amount when we get higher interest rates like we do now, or is it all fixed preferreds?
It's actually very, we have some hedges on it that we put in place a while ago, and they still have some life left to them. And depending on our spot, we'll lock in more. Obviously, interest rates are cyclical like every other part of the economy. So when they're low, we'll probably pick off some more. But if based on how the market reacted today, maybe they'll be lower sooner than anybody thought. But yeah, we try to, that's all accommodated sort of in our estimates. We're just more conservative than other money managers, I guess, because we're older and it's our capital, and we know things. And plus, we're just students of history. We know things go wrong for very often unpredictable reasons. So we just try to stay out of trouble. You can hear it when people ask you questions. I mean, I can't tell you how many times people have asked me the questions, Jim, if we have another recession, at which point I cut them off and I say, if? You mean when, don't you?
Yeah, exactly. All right, let's finish this up with one more about the nuclear. And I'll just shorten this and say, is the new baseload generation, is that going to add, if you will, to diminish, add more green energy? Let's say, is that going to be of size enough to move the needle?
I am an optimist about innovation and technology. You just have to wait for it to happen. And as you guys know, in Idaho, you will be the location of the next nuclear power plants built in the United States by a company called NuScale, which is making small modular reactors, and you're going to sell that electricity to the Utah Allied Municipal Power System, UAMPS, right? You guys know all that, right? And because it's going to be at the Idaho National Lab. And small modular reactors, I think are a sign of intelligence on this planet. And what I mean by that is when you look at nuclear power's problems, they are essentially threefold. The first is the risk of a meltdown, which scares the hell out of everybody. The second is the cost. In fact, you could say the first is the cost. You got to get past that before you got to get it built before it can melt down. And then how do you store the waste? Small modular reactors are addressing the first two. So there is this thing called Wright's Law, W-R-I-G-H-T, Wright's Law. You can Google it. There's a lot of research on it. And it basically tells you the cost of a widget is directly inversely correlated to the cumulative number of widgets that you've made. So in every big nuclear power plant you make is a unique design or size, you're starting at the beginning of the learning curve. And everything you learn on that nuclear power plant, you can't apply to the next one because it's going to be different. But a small modular reactor is made in a factory, and you will crank them out one at a time, and they're all small. They're all 77 megawatts as opposed to a big, nuclear power plant on the ground, which is being 1 and 2, or 1,000 and 2,000 megawatts. Okay, so it's a fraction of the size. It fits on the back of a truck, and every single piece of machinery on that device is an off-the-shelf vessel, pump, valve, and pipe. And so I've read a peer-reviewed paper on this very subject, and they used the standard engineering cost estimate handbook and went through it and basically said, yeah, this thing is going to be about half the capital cost of a field-built site, but the field-built sites all have 2x cost overrun, so it's going to be a quarter.
Mhm.
And so I'm optimistic that for that reason that they will take advantage of Wright's law. The risk of a meltdown is eliminated because of the design of the plant. It will not need pumps to cool off. Gravity will cool it off so that the reaction cannot run away. So it is literally physically impossible for it to melt down. And now you're left with the waste. And that's a function of how much money you want to spend processing it, because you can get rid of 95% of the waste by processing it. And as one person said at a nuclear power conference I attended earlier in the year, every single atom and molecule of nuclear waste generated in the United States is accounted for and known. And if you put all of it together, it would be a soccer field 4 stories tall. There's not another source of energy that can tell you where every molecule of its effluent is. It's somewhere in the atmosphere or run down a river or something. And so while it's scary, it's safe because it's scary. And they've solved with small modular reactors 2 of the 3 biggest problems with nuclear power. So I think with enough time, and this is conventional technology, by the way, this is just a light water reactor. This is not molten salt. This is not thorium. This is not anything new. This is the exact same mechanism of all the nuclear power plants in the world. 70% of the nuclear power plants, which are light water reactors, 30 are heavy water reactors. And so I'm optimistic about the future of that. All you have to do is spend 10 minutes with Ernie Moniz, who's the former Secretary of Energy under Obama. He's a nuclear physicist at MIT. He's a very pragmatic guy. I think he was successful as energy secretary because he understands sort of how to get things done. We know him through the Aspen Institute. I was on a panel he moderated a couple of years ago. You can be optimistic about this stuff. So people just had to figure out how to convince the public not to be frightened of it.
That's good. Jim, thank you so much. And we appreciate all your time.